What's up, you guys? Zoeb here from oneglancetrader.com, and in this video I'll be sharing with you what is, in my opinion, the quickest way and the easiest way to generate passive income and also wealth building strategies utilizing the stock market. And if you like the sound of that, all I ask in return is that you smash that like button and don't forget to subscribe either. Now, I've been investing now in the stock market for about 5 years, and I've seen, you know, boom markets. I've seen corrections or considered bear markets with, during the pandemic and then post-pandemic with that massive boom. And just very recently, from, beginning of December till, February 2022 year to date, where the market has been kind of correcting and or going into a potential bear market. And I thought to myself is, if I started investing today and I had a few $1,000s to my name to invest, how would I go about doing it after all the experience that I've kind of gained? And this is what you can see in front of you on the screen is what I've kind of come up with. I've sketched this out and I want to walk you through it step by step, and then where you can see where it says stock A, stock B, stock C is kind of put what I'm doing and the stocks that I'm investing in for this potential kind of wealth building passive income machine. And I was thinking about calling this video the pyramid scheme of investing, but not too sure how that would have gone down. But you can probably see what's happening here. It is kind of like a pyramid scheme, and again, this is going to become a cash engine for you, whether you want to take that cash and utilize it as income, or what I'm doing at the moment is reinvesting that cash back into stocks to build that long-term wealth, which will then compound over time to generate more cash for you as time goes on. So I'm really excited to be sharing with this. So make sure again that you like this video and comment down below on your view, and if there's any particular stocks that you're looking to investing in. So the first thing is where it all kind of, I think I've got it on markup. It all starts with this, what I call the cash cow stock. Now, this stock serves one purpose. It is to generate cash through selling options. Now, if you're brand new to selling options, I've got lots of videos on this. But in a nutshell, what we're doing here is we are selling options on the stock to generate a premium, and we use that premium that we collect to go and invest in stock A, stock B, stock C, which I'll go into. So there are a few criterias about this particular cash cow stock. So it needs to have a high volatility, and the reason why it has to be a high volatile stock is because the main focus of this stock is that it has to give us high premiums. The higher the premiums it gives, the more money we're going to generate out of this stock to go invest into the other stocks that we're going to go into. So that's the first criteria. The second criteria, you have to believe in this stock, if I can spell, if you have to believe in this stock for the long term, right? So it's a stock that you feel that is going to continue to rise over the long term, because again, you want to get some appreciation. Appreciation is not the be all and end all of this particular stock. This stock is, again, number one criteria is that it generates some good premiums with it. So that is, but it's nice to know if you believe in that stock, then you'll continue investing in that stock, and we'll also talk about that inside the second. So it's a stock with a high IV, and you believe in the stock. And what we're going to be doing with this stock is, like I said, we're going to be selling options and utilizing the wheel strategy. And the wheel strategy is where you firstly sell puts on the stock. So let's say the current price of a stock is $10 for argument's sake. You're selling puts below the current price at $9.50, $8.50, whatever it is, to go generate a premium. Now, there are many different ways or tactics you can utilize this stock. You can keep rolling it to avoid assignment, or you can get assignment and then start selling covered calls and slightly above your cost basis to get out of the stock. I'm not going to go into that much detail of this in this particular video, but essentially what you want to be doing is you want to be selling puts. If you get assigned the stock, you then want to be selling covered calls to go potentially get out of the stock, or potentially just keep rolling the covered calls if the stock continues to rise. And there's strategies you can use that if the stock continues to fall while you own shares, what do you do, and all these different things. But at a very high level, what we're only focused on here is to do the wheel strategy for this stock to generate income, and that's why I call it the cash cow stock. Now, how do you fund this stock? So you've got to start with some sort of capital to kind of begin with, and you know, and that's why my view is you should be doing this at a stock that isn't more than like $10 to $20. So therefore, to sell options on a stock, you need to have collateral for at least 100 shares. Now, 100 shares of a $10 stock is going to be $1,000. A $20 stock is going to be $2,000, etc. So if you've got that amount of money or capital, or there's a stock you like to do this with, you can do that. Or if you don't have that amount of money straight away, whether or not you can take a percentage of your income through your salary, through your job, whatever it may be, to work towards getting to 100 shares worth of collateral so you can start selling puts on this cash cow stock. So my cash cow stock, for those of you who watch my channel, probably can guess what it is. It is RIOT. RIOT is a Bitcoin mining company, so it's very volatile for the because it follows the kind of crypto market, and it pays some very good premiums. And we've seen 52 week highs of around $60. It's currently trading, I think it's trading around $19 or 19 to $20 by the time I'm recording this video. So what I'm doing here is I own 400 shares at the moment of RIOT, and this is generating a weekly income of around $30 a contract. So $30 per 100 shares, so $30 times by 4 contracts, 400 shares, is around $120 per week. So this cash cow at the moment is generating me $120 per week. So one of the things that I like to do with the cash cow is that if I'm, saying I'm putting 5% of my salary every single month into this kind of system, for more of a better term, any money that I put into my trading account all goes into funding the cash cow. So I don't really use my premiums that I generate. So this 120 does not go back into RIOT to buy more shares. What I'm doing here is putting an X amount a month until I get another 100 shares worth of collateral. Then I'll start selling some more puts on it to generate more income. So at the moment, I've built up 400 shares in this particular stock, so I'm generating $120 a week in this particular stock. So that there is the cash cow element of. Surely there's got to be a quicker way to object arrays. That's what I wanted of that piece. Hopefully that kind of makes sense, and that is the engine of this system to kind of generate the piece. So we want a cash cow stock that is continuously bringing us premium every week, every 2 weeks, every month, depending on your own criteria of selling puts and selling covered calls. I like to do weekly. Some people like to do bi-weekly, 3 weeks, 4 weeks. It doesn't really matter to a certain extent. And obviously, the more money that you have at the beginning or you're funneling in, the quicker the rest of the piece kind of works. So again, doesn't matter how small or how big your collateral that you can invest into the cash cow stock at the beginning. Over time, it will start building that particular piece. So let's say then we've got $120 here. So we now have, let's actually take that back out. So we've got $120 here coming in a week. Let's just put that out there. So the way I've structured this, and again, it is completely up to you on how you want to structure this. This is just my personal view, is I use the cash cow stock premium I generated. I invest it into uh, three different areas that I call a growth investments. I call this tech investments, but this is probably profitable tech. So not growth. Well, they can be considered growth companies, but growth companies that are actually profitable, and then dividend and income related stocks. So that gives me a good balance of the appreciation with growth and non-profitable companies that are have a good bright future according to my research. I then like the tech industry, and I like, profitable tech companies that I use every day and I invest in, and some, slower moving, not very big on the appreciation side, but they pay a dividend, and they all will also pay covered call premium as well to go reinvest back into the situation. And again, I've gone with stock A, B, and C, and then each middle stock will then give you two stocks. You could have three stocks here, or you could have just one, or just stock A, stock B, stock C. My view is not to have too many stocks, because then it becomes a bit more, not difficult to manage, but a bit more time intensive. It doesn't take that long generally, but it's just then, something that I think having one cash cow stock, 3, 6, and 9, so 10 really stocks in total that I'm managing at any one time. So and how you distribute this 120 is up to you. You could do, 33% here, 33% there, and 33% there. That's completely up to you on how you decide that you want to do it. From my personal perspective, is that I want to get stock A, B, or C up to 100 shares as quick as I can, because what you need is to sell options as similar to the cash cow stock. You need 100 shares of the underlying to be able to do that. Now, if I'm splitting 120 across three stocks, and we'll go into what these stocks are in a second that I personally invest in. Some of these stocks are like, $100 stocks for argument's sake. So you're gonna need 10 grand to be able to get to 100 shares, and that's going to take a long time. So what I personally like to do is I'm firstly going to focus on the growth area, because my stock A is currently a $25, $26 stock, so that's 2.6k needed. So I've got cash flow coming in from here. I'm also putting, X% a month into this one to build this up as quick as I can, and 100% first is going into stock A. And once I've got 100% into stock A, I will then start looking at into stock B, or putting a portion into stock B and into stock C. So again, the way you spread out your premium or your cash flow you're generating to these stocks, again, is completely up to you, how you want to actually do that piece. So if I look at my stock A piece, so in terms of the stocks that I personally invest in, this kind of setup that I've got that I'm doing, the first one is Lucid. So Lucid Motors, an EV company, very, very speculative stock. Doesn't make any money, won't make money for years to come. But the reason why I've chosen Lucid is that I'm long-term bullish on the EV market, and they also still pay pretty decent premium. And because they pay pretty decent premium, it means that I'll be able to generate cash flow a lot quicker. So I think and again, I'm just going to say this for argument's sake. Let's just say, for example, I can make $50 a week. Let's say I had enough capital. I had $2,800 to start selling puts on Lucid. And there's two things. And again, to draw this back, you can either save the cash flow to start building shares into Lucid, or to sell puts on it. But what I would strongly recommend is just buy the stock. Forget the price, just dollar cost average in, and don't worry about the price. So if I made $120 here, per week. I'm just going to buy Lucid at whatever price it is, whether it goes down, up, it doesn't really make a difference in this case, because what you want to do, the goal is to get to 100 shares as quick as you can. So then we get, let's say I get to 100 shares, I now start selling covered calls, and I generate $50 a week from Lucid. So now you can see now I'm making 120 per week plus $50 a week. So now what I can do with this $50, I can either treat it all as one with the 120 plus the 150, and then take all of that and start putting it into stock B, or I can start, buying shares, $25 into stock A2 and $25 into stock A1. Again, that is completely up to you. But just remember the goal. The goal is to get to 100 shares of a stock as quick as you possibly can. So then and once you've done that for stock A1 and A2, those stocks will start bringing you passive income and generating X amount per week to make this bigger piece there. So let's just say, again, I'm just going to make this up. Let's say that you get to 100 shares of stock of A2, that gives you $10, and this gives you $20 a week. So now let's just say you've got 120 from your cash cow. Stock A gives you $50. Stock A1 gives you $10. Stock A2 gives you $20. So that's now $180 per week now that you're generating. And also you own assets. Those assets, if they're things that you believe in long term, and again, the same rules apply with your cash cow stock, they don't need to be as volatile in terms of premiums, but it's companies that you like and you believe in long term. So you're going to get the appreciation of this, as well as getting to 100 shares to go sell cover call premium. So in terms of the stocks that I've put here, this one is Robinhood. So the broker that getting absolutely decimated. For the growth side, I have gone with more slightly higher premiums because I just want to generate more cash flow. And then the third one is SoFi, which is the financial company that does kind of loans for students, as well as credit cards and all these other different things. So we've got RIOT here. We've got Lucid, SoFi, and Robinhood. And I'll go in a bit quicker now because the same concept kind of applies here. And again, profitable tech perspective for me is Meta. So I currently own 2 shares of Facebook currently, which I'm starting to build up. On there, and again, this is mainly down to the stock's been decimated, but I'm very bullish on the metaverse and all these other things. And Facebook have renamed themselves to Meta, so they are going all in on this piece here. So they're going to be the leaders in this place, and I can see this stock going to $1,000 stock at some point, and it's currently sitting at 250. So at the moment, I'm very heavily trying to invest, trying to get a couple of shares a week into this based on my cash flow, my stock A piece generating more. The next one inside this place over here is going to be what was it down here? I've got it written down, is AMD. And the next one that I've put in here isn't really a profitable tech stock or anything like that, so it kind of goes below it, is Coinbase. And Coinbase, again, is similar to RIOT. It's less correlated to the crypto market, because this looks at the overall crypto market, as opposed to RIOT is very edgy on Bitcoin. It's just a very good cash flow, high premiums, high cash flow kind of related stock. And then you got your kind of safer ones here, and there's no surprise on the first one is Apple. Apple pay a dividend of 0.5%. The next one is Coke. I love Coke. I love the brand. I love everything about them. They pay 2.74%. And then the third one is a bit more of an aggressive one from a dividend perspective, is a Realty Income. They are a REIT, so they invest in real estate, into a portfolio of real estate, and you get dividends back of that at currently 4%. 4% return. So those are kind of the stocks that I'm looking at. Again, I'm not saying to invest in any of these stocks. It's more about the processes that you are building. And the bit I like about this, two things what I like about this from a psychology point of view. The first one is, let's say you get to 100 shares of Lucid, right? You didn't actually invest your own money into Lucid. It's the income or cash flow you generated from your cash cow stock, which paid for 100 shares of Lucid. Now, how powerful is that? And one thing I forgot to remember is on these particular ones, where you're doing the wheel strategy on your cash flow stock, all these other stocks, stock A, B, C, and A1 to A3, or however you decide to do it, is you want to keep for the long term. So you want to sell covered calls outside of your cost basis, and roll them up every single time as the stock price moves up. And if, for example, you do get assigned, hopefully it's above your cost basis. Again, you can just start selling puts on stock A, stock B, stock C, because here is you're trying to again get the appreciation, but also the covered call income from that piece there. So I really hope that kind of makes sense. And again, oh no, sorry. And then the last bit from a psychology point of view is, and something is a bit more advanced, is selling options below your cost basis. So let's say I owned 100 shares of Lucids, which was paid for across 10 to 20 weeks of selling cover calls and puts on RIOT. And let's say your cost basis of Lucid was 28. Let's say Lucid drops to $14, right? Now selling cover calls at 28 is pretty much going to be peanuts. I'm not saying this is what people should do, but I'm of the opinion it's very unlikely you're going to get assigned a covered call where the current price is below your strike price. So I'll be happy selling cover calls at $17 for argument's sake. And if Lucid pops back up, I'll just have to roll it out for a month or something like that, just so I don't lose the shares on it. But even if I did get early assigned, I didn't use my own money to pay for it. RIOT paid for it, for more of a better term. So I'm not too worried about it, because all I'm doing is giving back cash flow or generated income that I kind of made. But hopefully, as you cost average in, um, that kind of helps you. And then the last piece I wanted to add is the concept of leveling. So games like World of Warcraft, where where you're and again, I'm not a fan in terms of that, but I played various apps and stuff where it has a leveling up system. So if you think about shares as one share is level 1, 100 shares is level 100, and there's a gratification of taking that $120 of premium and buying 5 shares of Lucid. Now I'm up to level 5 on Lucid. And when you get to level 100, right, and depending on what, and things will change, is, and let's say you're generating $500 whatever a week, I don't mind buying 1 share of Apple over here and getting Apple to level 4, right? Or let's just say Facebook drops slightly, so I'm going to actually put some of my income into Meta and buy another 2 shares of Meta, right? Get that. And not to say that you have to stay at level 100 or 100 shares. Like when I get to Lucid or to 100 shares, every now and again I might just pop in and just buy some more shares of Lucid to get to 200 shares eventually, and then it all compounds after that, which is why my suggestion is don't focus on don't extend out these branches, because then it'll take you longer. The smaller the amount of stocks that you've got, and you can concentrate on building up 100 shares, then 100 shares plus, and then as your income grows through here, when you're making 1,000 a week, 2,000 a week, 3,000 a week, whatever it may be, you can then say, actually, I do like this other stock. I do like ChargePoint. I do like Palantir. I do like Intel. I do like IBM, whatever it may be. Then you can start adding another stock to your kind of portfolio, and all these other different things. So I know it's a bit of a longer video and I've kind of scribbled everywhere across this piece, but hopefully that kind of makes sense to you guys on what we're trying to do. So make sure you drop a comment, drop a like, and I should see you guys